Nobody starts investing knowing what they are doing. Nobody. Every person who has ever built serious wealth in the stock market started exactly where you are right now. Confused about where to begin, unsure which account to open, overwhelmed by the options, and wondering whether they are already too late to make any of it matter. The difference between the people who figure it out and the people who never start is not intelligence. It is not access to insider information. It is not even the amount of money they started with. It is that at some point they stopped waiting to feel ready and started learning by doing. And the framework they built, the simple, repeatable system for finding great companies, buying them at the right price, and holding long enough for compounding to do its work, is exactly what we are going through today. My name is Tomas, and this channel is about finance, automation, and building wealth through strategies that are proven, practical, and completely replicable. If you are new here, welcome. Hit that like button right now and subscribe so you never miss a video. Today, we are going through the full beginner guide to investing in stocks, the same framework behind millions in returns, explained clearly, step by step, from the very beginning. Let's get into it. Let us start at the most fundamental level, because getting this foundation right is what separates investors who build real wealth from investors who get lucky once and then give it all back. What you are actually buying when you buy a stock. Most beginners think of stocks as numbers on a screen, prices that go up and down, things to be traded based on momentum, news, or gut feeling. That mental model is the foundation of almost every investing mistake a beginner makes. Because a stock is not a number. A stock is a fractional ownership stake in a real business. When you buy one share of a company, you own a tiny piece of that company's assets, its future earnings, and its long-term growth. You are not betting on a price. You are buying a business. This distinction changes everything about how you make decisions. When you think of stocks as prices, a falling stock looks like danger. When you think of stocks as businesses, a falling price on a great company can look like an opportunity. When you think of stocks as prices, you check them obsessively and react emotionally to every move. When you think of stocks as businesses, you evaluate them the way you would evaluate any business you were considering buying, by looking at the fundamentals, the competitive position, the management team, and the long-term earnings potential. Warren Buffett has said that if you are not willing to own a stock for 10 years, do not even think about owning it for 10 minutes. That principle, buying businesses rather than trading prices, is the single most important mental shift any beginner investor can make. Everything else in this guide builds on it. How to evaluate a business before you invest a single dollar. Once you understand that you are buying a business, the next question is obvious. How do you know if a business is worth buying? There are 4 things to look at. And while entire books have been written on each of them, the core of what you need to know as a beginner is simpler than the financial industry would like you to believe. The first thing to look at is the business model. Does this company make money in a way that is easy to understand? Does it have a clear and durable competitive advantage, something that makes it genuinely difficult for competitors to take its customers? This is what Buffett calls a moat. Companies with strong moats, dominant brands, network effects, switching costs, cost advantages, or proprietary technology, tend to maintain their profitability over long periods. Companies without one are constantly under pressure from competition. Start with businesses you understand and that clearly have something protecting their position. The second thing to look at is the financial track record. Is the company growing its revenue and earnings consistently over time? A company that has grown its earnings at 10 or 15% annually for the past 5 to 10 years is a very different investment than one whose earnings are flat, declining, or erratic. You do not need to be a certified accountant to read a basic income statement. Look for consistent, upward trending revenue and net income over at least 5 years. If the trajectory is clear and consistent, that is a strong signal. The third thing to look at is the balance sheet. Does the company carry excessive debt? A business with more cash than debt and strong free cash flow generation is a business that can survive bad years, fund its own growth, and return capital to shareholders. The fourth thing to look at is the valuation. Even an incredible business can be a bad investment if you pay too much for it. The price-to-earnings ratio, commonly called the P/D ratio, is the most basic valuation tool. It tells you how much the market is currently paying for every dollar of the company's annual earnings. A company with a price-to-earnings ratio of 15 is cheaper relative to its earnings than one with a ratio of 40, all else being equal. There are nuances here. Faster-growing companies deserve higher valuations, but the principle is sound. Great companies bought at reasonable prices produce great long-term returns. Great companies bought at extreme valuations can produce mediocre or even negative returns, even if the business itself continues to do well. The role of index funds in a serious investment strategy. Here is something that separates honest investing education from the version designed to sell you complexity. For the vast majority of investors, including many sophisticated ones, the core of a long-term portfolio should not be individual stock picks. It should be low-cost, broadly diversified index funds. The evidence on this is not ambiguous. Over any extended period of 20 years or more, approximately 80 to 90% of actively managed funds, run by professional investors with research teams, sophisticated tools, and decades of experience, fail to outperform a simple index fund tracking the S&P 500. The reason is not that those professionals are incompetent. The reason is that markets are extraordinarily competitive, and the cost of active management consistently erodes the returns even when the stock selection is good. For a beginner building a portfolio from scratch, the right approach in almost every case is to make index funds the foundation, the core 60 to 80% of the portfolio that provides broad market exposure at minimal cost, and then allocate a smaller portion, if desired, to individual stocks in companies you have researched thoroughly and understand deeply. This structure gives you the proven long-term returns of index investing as a floor, while allowing for the potential upside of individual stock selection in a controlled, disciplined way. A 3-fund portfolio, a total U.S. stock market index fund, a total international stock market index fund, and a bond index fund weighted according to your time horizon, is one of the most elegant and effective investment frameworks ever developed. It costs almost nothing to hold, requires almost no management, and has produced exceptional results for investors who have stuck with it over decades. The power of compounding, and why time is worth more than any stock pick. Every serious investor eventually arrives at the same conclusion. The most important variable in building wealth through stocks is not finding the best company, not buying at the perfect price, and not avoiding every downturn. It is time. Specifically, the length of time that money spends compounding in the market without being withdrawn. Here is the math that makes this viscerally clear. $100,000 invested at an average annual return of 10% becomes $259,000 after 10 years. After 20 years, it becomes $672,000. After 30 years, it becomes $1,744,000. The money more than doubles in the first 10 years. It grows by more than the entire original investment in the second 10 years. And in the third 10 years, it adds over $1 million more. The same 10% annual return. The same $100,000. The only variable that changes is time. This is why starting matters so much. And this is why panic selling during market downturns is so financially catastrophic. Not because the paper loss in the moment is devastating, but because leaving the market for even a small number of months during a recovery can cut the long-term outcome dramatically. The 10 best single trading days in any given decade are responsible for a disproportionate share of the total decade's returns. Miss those days by being out of the market, waiting for things to feel safe again, and the compounding math changes fundamentally. The practical implication is simple. Invest early. Invest consistently. Stay invested through every correction, every recession, and every headline that makes the market feel terrifying. Reinvest every dividend automatically, and never touch the principal. The people who build millions in the stock market are almost never the most sophisticated traders or the most accurate forecasters. They are the most patient holders. Time and consistency are the edge, and unlike stock-picking skill, they are available to every single person watching this video right now. The habits that separate investors who succeed long-term from those who do not. The framework is only worth as much as the habits built around it. And there are 4 habits that show up consistently in the financial lives of investors who build serious long-term wealth. The first is automatic investing. Setting up recurring contributions to investment accounts on payday, before the money can be spent on anything else, removes the decision from a moment of temptation and makes wealth building structural rather than dependent on discipline. The best investment system is the one that runs without you having to remember to run it. The second is leaving investments alone during downturns. The investor who checks their portfolio every day and reacts to every piece of news will, on average, underperform the investor who checks quarterly and does nothing. Volatility is not a problem to be solved. It is the price of admission for long-term returns. Paying that price calmly and consistently is the skill. The third is continuing to learn without acting on every new piece of information. The financial media is designed to generate engagement, which means it is designed to make you feel like something requires your attention right now. Most of the time, the correct action for a long-term investor is no action at all. Read, learn, and understand more. But resist the urge to translate every new insight into a portfolio change. Stability and consistency compound just as powerfully as returns. The fourth is regularly reviewing and rebalancing. Not reacting to markets, but periodically checking that the portfolio allocation still reflects your goals and time horizon. Once a year, look at whether the proportions of your portfolio have drifted significantly from your target allocation due to market movements and, if so, bring them back into alignment. This is the only active management most long-term investors ever need to do. So there it is, the full beginner framework for building real wealth through stocks. Understand that you are buying businesses, not trading prices. Evaluate those businesses on their competitive moat, their financial track record, their balance sheet strength, and their valuation. Build a foundation of low-cost index funds, and add individual stocks only for the portion of your portfolio you have genuinely researched. Respect the mathematics of compounding by starting early, staying invested, and never pulling out during the downturns that feel the most frightening. And build the 4 habits: automatic investing, holding through volatility, learning without overreacting, and annual rebalancing that make the strategy sustainable for decades. There is no secret to building millions in the stock market. There is only the right framework, applied consistently over a long enough period of time. Start now. Stay the course. Let compounding do what compounding does. If this video gave you a complete foundation to start from, please hit that like button. It genuinely helps this channel grow. And if you are not subscribed yet, click that button right now so you never miss what is coming next. See you in the next one.